Hi, welcome back. Can you predict future prices by looking at past prices? Can you use charts to actually make money? I'd wager most academics might say no, most value investors will say no, but there are lots of investors out there, tens of thousands, who use charts and try to make predictions based on charts or believe at least that past prices provide information about the future. Are they crazy? That's what I'd like to start examining in this session. The counter to most of those people who build off past prices is what's called the random walk. According to the random walk, for any given moment in time, the next minute, the next hour, the stock price change is going to be random. In other words, there's a 50% chance it'll be higher, 50% chance it'll be lower. There is zero information in past prices. How do the random walk people come to that conclusion? Let's build up to the random walk. Here's how the random walk hypothesis is built. In the random walk world, all information about a company is available for investors to trade on. Those investors are rational. They form unbiased expectations about the future based on that information. The stock price then reflects those unbiased expectations by providing an unbiased estimate of the value of the stock, and then new information comes out. Almost by definition, if all the existing information is incorporated in the price and it's an unbiased estimate of value, the new information has a 50-50 chance of being good news or bad news. In other words, if I thought that the new information was going to be disproportionately good news, I'd have adjusted the price already. It sounds circular, but if prices are unbiased estimates of value, the new information has to be random. 50% chance of it being good, 50% chance of it being bad. If that's the case, the next price change will also be random. That is the basis for the random walk. And you can see it's built on three blocks. One is the information block, that information is available and accessible. The second is the investor block, that investors are rational about creating unbiased expectations. And the third is the market block, that the price reflects those unbiased expectations. Well, of course, if you break any of those assumptions, you have price patterns. In fact, there are people who argue, and it's not just chartists. I mean, the behavioral economists, for instance, who argue that investors are not always rational, even if they have the information in how they set expectations. That sometimes they set these expectations too low, in which they set themselves up to be surprised positively over and over again, or set them too high, in which case they're going to get negative surprises over and over again. And secondly, that price changes themselves may provide information to other investors. What I mean by that is many investors lacking a rudder will often look at what other people are doing. So if everybody else is buying, it becomes the equivalent of good news. They must know something that I don't, so I'll buy too. So whatever the reason, there is a healthy subgroup of investors who believes that there are price patterns. So it's worth examining whether their belief is based on reality or whether it's fantasy. So investors have always used price charts. One very simple way to check to see if there are price patterns is to look at the correlation in price changes over time periods. In other words, if I told you what happened in the last period, can you tell me what will happen in the next period? And if you look at the evidence on this phenomenon, it can be broken up into four groups. The first set of studies look at really short-term periods. In other words, minutes, hours. In other words, if I told you what the return was in the last 20 minutes, can you tell me what the return will be in the next 20 minutes? So I'm going to start with those really short-term studies. The second set of studies move up the ladder a little bit. They look at daily or weekly prices to see if there's a pattern there. Then you move even further up at 6-month annual returns, and then finally look at really long-term returns, 5-year returns, 10-year returns. The reason I break this up this way is the evidence actually seems to go back and forth. When you look at really short-term returns, the consensus view is that there's very low or no serial correlation. And if there is serial correlation, it's often driven by market microstructure rather than any inefficiency. What do I mean by market microstructure? Take, for instance, the bid-ask spread. If nothing else, the bounce that happens between the bid price and the ask price is going to make it look like there's negative correlation in very short-term returns. And also, if there's a liquidity problem, you can have some very, very small positive serial correlation if markets are not liquid. So if you look at really short-term returns, the correlation is really low or zero. You say, let's say it's really low. Can you make money on it? Most of us as individual investors are incapable of making money on it because it requires us to trade huge amounts of shares in really short time periods. It is possible that if you had access to a lot of funds and you were able to get a computer to trade for you, you might be able to take advantage of even these very, very small serial correlations. But that's in fact the phenomenon of computer-based trading that you've seen in the last few years, where at least some investors seem to have been able to make money off those computer trading. But even those returns are starting to dissipate as more people bring computers into the game. So really short-term returns, not much evidence of serial correlation, and if there's any serial correlation, it seems to be caused more by how the market is structured in terms of liquidity and bid-ask spreads than any inefficiency in the market. Move one step up the ladder. Let's say you go from minutes and hours to days and weeks. There you start to see evidence of at least mild negative correlation. So if you look at weekly returns or daily returns, there seems to be some evidence of reversal in returns in the short term. In other words, if yesterday or last week was a good positive week, this week is more likely to be a negative week than a positive week. In fact, this particular graph shows you the returns you could have made on an annual basis by trading on that short-term serial correlation, and it looks pretty impressive, right? For instance, if you look at, this is done by decade, so 1929 to 39, 30, so basically, at least for the 1920s and 30s, it looks like you could have made almost 18% annual returns by just reversing or going against what happened last week. So what this would mean is if a stock would drop last week, you would buy it and hold it for the next week. If it went up last week, you'd sell short for the next week. But those returns, though, are a little deceptive at two levels. One is, notice that they have varied by decade. The second is they're before transactions costs. And you're going to be trading a lot with these strategies. And it's not clear that you're going to be able to keep much of these returns after you've accounted for transactions costs. So with very short-term returns, there's little or no serial correlation, and whatever serial correlation there is caused by market microstructure. As you go to days or weeks, there is negative serial correlation, and these might be inefficiencies or reversals. And it looks like you can make money on these strategies if you have no transactions cost, but with transactions cost, it looks like these returns will get eaten away. And if you move further up the ladder to many months or years, 6-month periods or year period, you start to see positive correlation again. In other words, you have negative correlation in days or weeks, but you have positive correlation if you look at 6-month or 1-year periods. What do I mean by this? If last year was a good year for a stock, it went up a lot, then next year is more likely to be an up year than a down year. There seems to be positive momentum. And in fact, Jagadish and Titman, who did the paper that kind of laid this out, used 6-month time periods. Basically, they took the stocks that have gone up in the last 6 months and showed that those stocks over the next 6 months are going to deliver higher returns than the stocks that went down the most over the last 6 months. In fact, if you followed their strategy of momentum between 1945 and 2010, you classified stocks into deciles, 10 deciles based upon what the price performance over the previous year was, the annual return you'd have got by buying the top momentum stocks, the stocks in the top decile, would have been 16.5% higher than the returns you'd have made by buying stocks in the bottom decile. That's a pretty powerful result. It shows you that momentum, which had gone from being close to zero in very short-term returns to negative in daily or weekly returns, is now back to being positive. That's a momentum story, and in fact lots of investors play that momentum game where they look at stocks that have gone up the most in the most recent past and jump into those stocks. I would argue that much of institutional investing is driven by this momentum phenomenon, and much of the time it seems to make the money until it doesn't. Which brings me to more evidence on this momentum factor, because it has become a fairly strong factor in markets, and at least it's a recognized factor. Here are some of the other things that have been uncovered in the context of momentum. Momentum that is accompanied by higher trading volume seems to be stronger and more sustainable, lead to higher returns, and momentum that is not accompanied by higher trading volume. Momentum in small stocks seems to be larger than momentum in large market cap stocks, though the relationship is a fairly weak one, and there are sub-periods where you see this reversed. Momentum on the upside dominates over long time periods, but downside momentum wins out in some very small sub-periods. And momentum is more sustained and stronger for higher growth companies with higher price to book ratios than for more mature companies. So not only is there momentum, but it seems to vary across subsets of the market. Which brings me to the last set of studies that look at serial correlation, or how quickly prices reverse themselves if you look at longer period returns. So this is a study from Farmer and French which looked at 5-year returns. So basically they look at stocks that have gone up the most in the last 5 years and gone down the most, and then look at the following 5-year period. And there they find significant negative correlations. So basically, if the way to read this graph is, these are the negative correlations. So if you have no relationship at all, these numbers should be zero. But if you see these, if you look at numbers which are negative, you're seeing a reversal. So stocks that have gone down the most go up the most in the next. And they reported both 5-year and 1-year returns. And you can see the 1-year results are much weaker. But in the 5-year time period, stocks that have gone down the most are more likely to bounce back up. Okay? So that's really, I think, the story with momentum. If you ask me, is there momentum in markets? My answer is absolutely. If you ask me, can I make money off momentum? My answer is going to be more nuanced. You can make money off momentum until it stops working. And the problem with momentum is you're in a sense being borne up by the mood of the market, but the mood can change. And when the mood changes, it can wipe out all the money you made on the way up with momentum. So momentum is a very dangerous game to play. There are some people who are very good at playing that. And the people who are good at playing the momentum game are very sensitive to inflection points. They seem to be able to get out just before the momentum shifts. And you could argue that that's what charts and technical analysis is best designed to do. A good chartist or a good technical analyst is constantly looking for ways that will give him a preview or a prior that momentum is shifting and allow him to get out before the momentum shifts. Because if you wait till the momentum shifts, it is going to be too late. Okay? So that's the momentum story, and in very, very extreme cases, of course, momentum is what creates bubbles. So I call these extreme momentum stories, where momentum pushes a price way above the value but continues to push it up. The fact that your momentum behind you keeps pushing the price further away from the value, and that's the definition of a bubble. And after the fact, we can always look back and point to these bubbles, right? The dot-com bubble, the tulip bubble, the South Sea bubble. And over time, these bubbles, in hindsight, seem obvious. It's actually a much more difficult task separating bubbles from what I call blunders. And what I mean by that is markets do make mistakes, and it's when they make mistakes, the price wanders away from value. It's very difficult to tell when a market's made a mistake from when you have a bubble. After the fact, while it looks obvious, lots of so-called bubbles were really just market mistakes. So I would argue that if you're an investor and you want to incorporate momentum into your investment strategies, please do so, but do so with caution. If you're an investor and completely dependent on momentum on making money, then you better be really good at this game. Not only at detecting momentum, but detecting shifts in momentum. That's key. If you can detect shifts in momentum before other people can, you will make money off momentum. If you cannot, you will lose money. So in summary, if you look at people who look at past prices to predict future prices, they are in fact challenging the classic random walk. The classic random walk, though, is built on the premise of information being available to investors, investors being rational, and market prices reflecting those rational investor expectations. To the degree that one or more of these assumptions breaks down, there will be price patterns, and if you look at the evidence, there seems to be evidence of price patterns. The evidence, though, shifts depending on whether you look at really short time periods where there's almost no price pattern to days or weeks where you do see some reversal in prices, to months, to 6 months, to even a year where you see positive momentum coming back, and that reverses when you go to 5-year return. So you can already see how tenuous momentum investing can be depending on how you slice your investment strategy. So be cautious, but clearly there is information in prices that we should be able to use in investing. In closing, when I started investing, I did not use charts. Now I am willing to consider using technical indicators and charts in conjunction with intrinsic valuation, because I think they can help you in timing an investment a little better. And the name of the game is making money. Why leave tools inside the tool chest if they can be useful? That's about it. Thank you very much for listening.